Goldman Sachs, one of the most powerful investment banks in the world. In 2025, they quietly rolled out something called the GSAI Assistant, a tool now running across the entire firm, helping employees summarize complex documents, draft content, and run data analysis. Around the same time, JPMorgan filed a trademark application for something called Index GPT, an AI system designed to select financial securities and assets for customers. And Morgan Stanley? They put GPT-4-powered co-pilots directly alongside their financial advisors. These are not startups. These are not experiments. These are the three most recognizable names in global finance, and they are all right now replacing parts of what financial analysts do. So let's ask the question directly and answer it honestly. Welcome to AI Capital Code, where we crack the code on what artificial intelligence is actually doing to money, not the version that makes you feel better, the version backed by real data. This video is about one question: will AI replace financial analysts? We pulled 6 major research reports published in 2025 and 2026 to find out. The answer is more specific and more urgent than most people are telling you. Let us start with what is already happening, because this is not a future prediction. It is a current reality. A financial analyst today spends a large portion of their working hours on tasks that fall into a very specific category: reading documents, extracting data, building first draft models, writing routine research summaries, processing filings, and generating reports. These tasks share one characteristic: they are high volume, rules-based, and language-heavy. And that is exactly the category where AI is already performing at or above human level. JP Morgan is running more than 450 active AI agents in production. Their coin platform already reads commercial loan agreements that used to take lawyers and analysts 360,000 hours a year to process. Goldman Sachs reported their AI assistant completes research summaries that used to take 2 hours in under 15 minutes. MasterCard's AI system now screens more than 160 billion transactions for fraud, making millisecond decisions that no human team could approximate. This is not what is coming. This is what is already deployed. Now, here is the part that makes this genuinely dangerous for anyone in a financial analyst role today. And it is the finding that most commentators are quietly stepping around. BCG published a major workforce analysis in March 2026. They studied roughly 1,500 distinct job roles across 165 million US jobs and classified each one based on how AI automation would actually affect hiring. Financial analyst roles landed in what they call the substitution category. Here is what that means in plain language. When AI automates routine modeling, data aggregation, and initial analysis, the volume of financial analysis does not grow to absorb the productivity gain. The output is tied to existing reporting cycles and investment mandates. So when AI makes one analyst do the work of 3, companies do not hire 2 more analysts. They hire 1, or fewer. BCG's conclusion was direct. Productivity gains in financial analysis are more likely to reduce the number of analysts required than to drive additional hiring. That is a fundamentally different finding from the reassuring narrative that says AI just makes analysts more productive and creates more jobs. BCG is saying the opposite. The productivity gain goes to the company's bottom line, not to a bigger analyst headcount. Bloomberg Intelligence puts a number on this. Wall Street banks are projected to cut up to 200,000 jobs over the next several years due to intelligent automation. Junior associates and entry-level analysts are among the most exposed. One 2026 career analysis put the displacement risk for financial analysts who do not adapt to AI tools at 85%, meaning 9 out of 10 analysts who do not learn to work with these systems will lose ground to those who do. Entry-level positions specifically are projected to decrease by 40% by 2028. The tasks disappearing fastest include first draft report writing, basic financial modeling, KYC documentation checks, standard earnings call summaries, and data extraction from filings. These are the exact tasks that define the first 2 years of most analysts' careers. India's own job market data reflects this shift already. Naukri recorded a 12% year-over-year decline in BFFSY job postings as of June 2026, even as demand for domain plus AI hybrid roles rose. This is where fear has a real foundation. For anyone currently in an entry-level analyst position or studying to enter one, the traditional path, join as a junior, spend 2 years doing manual modeling and research, get promoted based on volume of output, that path is compressing fast. The analyst class of 2027 will be smaller than the class of 2024. Not because companies are doing less analysis, but because AI is doing the part of the work that used to require a large junior bench. And yet, here is where the honest answer becomes more nuanced, because the research does not say the profession disappears. It says it restructures, and that restructuring creates a split. Brookings published a detailed study on what AI cannot displace in finance. Their conclusion pointed to something they called tacit knowledge, the unspoken, experience-based intuition that professionals build over years. The judgment call that corrects for an outlier a model cannot explain. The instinct that says this deal does not feel right, even though the numbers say it works. The ability to read a room, manage a client relationship through a market downturn, and make an accountable recommendation when the data is ambiguous. Goldman Sachs CEO David Solomon described it as the last 5%. AI can draft the memo, run the model, and generate the scenarios, but the call, the judgment, the accountability, that is still human. No study published to date puts client advisory, complex deal structuring, ethical decision-making, or senior risk sign-off on a fast decline list. New roles are already forming at the intersection of finance and AI. AI-enabled financial planning and analysis managers are now commanding salaries between $130,000 and $198,000 a year. AI governance and compliance managers, professionals who understand both financial regulation and algorithmic systems, are among the most in-demand hires at major banks. These roles did not exist 5 years ago. They exist now because someone has to direct, audit, and take legal accountability for the AI systems that are making decisions inside regulated financial institutions. Anthropic's own labor market research found financial analysts among the most AI-exposed occupations, but also found no current impact on unemployment rates, with the clearest effect being a slowdown in hiring for workers aged 22 to 25 entering the field. The profession is not collapsing, its entry point is narrowing, and its skill requirements are shifting upward fast. So here is the honest summary of where this leaves us. The analysts most at risk are the ones whose entire value proposition is speed of manual output, how fast they can build a model, how many filings they can process, how many summaries they can write. AI has already matched or exceeded human speed on all of those tasks. The analysts who are genuinely secure are the ones whose value is judgment, relationships, accountability, and the ability to know when the AI is wrong. The transition between those two profiles is not gradual. It is happening now, and the 2026 hiring data shows it. Goldman Sachs, BCG, the IMF, and Citi all reach the same conclusion across different methodologies. Tasks automate, roles transform, and the skill bar moves up. Being exposed to automation is not the same as being eliminated, but it is also not the same as being safe. The practical takeaway: whether you are in finance, hiring for finance, or investing in companies that employ large analyst teams, is that the value of an analyst is no longer measured by how much they can produce manually. It is measured by how much they can produce with AI and whether they can tell the difference between a correct output and a convincing mistake. A financial analyst who cannot use these tools is already at a disadvantage. A financial analyst who uses them without understanding how to audit them is a liability. And a financial analyst who can do both, who brings real judgment to AI-generated work and takes accountability for the final call, is worth significantly more than they were 3 years ago. Let us be even more specific about the timeline, because the numbers shift fast. By 2026, AI is already generating roughly 80% of routine financial models and first draft reports at institutions that have deployed it at scale. By 2027, Real-time AI market analysis is expected to make traditional quarterly analysis cycles obsolete, meaning the analyst who produces a monthly research note is being replaced not by another analyst, but by a system that produces the same output continuously. The IMF estimated in January 2024 that roughly half of AI-exposed jobs in advanced economies would benefit through higher productivity. But benefit does not mean job security. It means the analyst who learns to work with these systems becomes dramatically more productive, while the analyst who does not becomes redundant. The productivity gap between those two groups is already visible in compensation data. PwC's June 2025 wage analysis found a measurable premium attaching to AI skills in finance roles. Not certificates, not years of experience, not the traditional markers, AI tooling proficiency. That is the signal that tells you where the market is actually moving. The rules of this profession just changed. The question is not whether AI is coming for financial analyst roles. It already arrived. The question is which side of that 85% gap you end up on. Next on AI, capital code, agentic AI. The AI quietly running parts of your business right now, why 95% of private equity firms are already using it, and what it means when an AI does not just answer your question, but completes the entire job without asking. Subscribe so you do not miss it. And if you work in finance or have worked alongside AI tools, tell me in the comments what has actually changed in your day-to-day life.